You're listening to Real Investor Radio with Craig Fuhr and Jack Bevere, where we cover advanced real estate investing topics to help you stay ahead of the curve in your real estate investing business. Well, hey, it's Craig Fuhr coming again from Real Investor Radio. Welcome, welcome. This is episode 22. Jack, how are you today?
Doing wonderful. How are you, sir?
Doing well. As always, joined by Jack Bevere from an undisclosed bunker. Where are you, Jack? Where are you today?
I'm in Baltimore. Today.
Well, it's good to be home. So, man, we've got a lot to talk about today. Got a whole bunch of articles that I'd like to go through. And I know you just had a great meeting of a bunch of top investors from around the country. We'll touch on that. For those of you who didn't catch our last couple of episodes, we spoke with an analyst by the name of Melody Wright. Melody was fantastic. She's been in the industry for quite a while, in the mortgage industry, mortgage tech, and had some really cool takes on where she thought the market was going in terms of housing, demand. We had a really lively discussion with her, and some of which I think we agreed with, Jack, and some of which we did not. And I just wonder if you might want to touch on that for a little bit. Guide folks back to those two episodes, which I think were really fantastic. If people hadn't had a chance to listen to them.
Melody's super smart, very well read on housing economics, and she's got some really contrarian views that are based off of her firsthand knowledge and research of having physically visited a lot of job sites, home building job sites, specifically across the country, and her view that there's a dirty secret basically in home building, and that the home building industry has really overbuilt the wrong kind of housing for the country. It's not affordable, and it's sitting there. And she likens it to the kind of overbuilding that happened that led up to the Great Recession. And it's her view that that we are going to enter a housing crisis that is on the same scale, if not worse, in her words, than what we experienced 15 years ago. She gave me a ton to think about, and frankly, we were pressing her a little bit on different aspects of her thesis there, but frankly, she's very well thought out on it, and it gave me a lot to think about. I spent a bunch of time in the past couple weeks since then really trying to vet her thesis, and wonder, maybe she sees something that none of us see, and we'd be wise to take heed. I can't quite get there. I'm still not nearly as pessimistic as she is about. I do agree with some of her fundamental ideas that we've overbuilt a lot of the wrong inventory, and it's not affordable, and certain projects are going to languish for a number of years because they're just not what the market wants right now. I just don't think but frankly, I just don't think it's on the same scale as what she does. And I don't see it as a harbinger of doom in the housing economy the same way that she does.
It's funny. I don't want people to, when they listen to the show, to think that we have this sort of dour look about everything in terms of the market. In fact, I really think there's tremendous opportunity that's coming. But it feels like, in any given episode, no matter who we have on, they're going to have an opinion. It's generally based in fact, but it's amazing to me, Jack, how varied the opinion is amongst analysts. And I can't say that I'm surprised. I think that's always been the case. If you get two analysts or two economists in a room, you're always going to get two different opinions. But I wanted to go through today in some depth on this episode this really great report that you had sent me from Wolf Research. Wolf Research is a company of analysts. Essentially, they have over 25 analysts, and they cover 600 plus companies in the home building space and in different industries. In fact, 81 different industries across the spectrum. And so I had this very extensive report that you sent me, Jack, and I thought we would just go sort of bullet point by bullet point, where They basically sat down and they had a bull thesis of the market and a bunch of bullet points supporting that, and then and then a contrarian bear thesis. And I thought it would be interesting to go through that for the listeners. So we can jump into that if you'd like.
Yeah, absolutely. I think it's an excellent compilation. It was Wolf Research is not something I was previously aware of. One of my best friends who actually got married this past weekend, shout out to Jason Minzer of Timberlake Homes, Jason forwarded me a Wolf Research piece that he thought I would find interesting. And I went to their website. They've got a ton of free content that is really high quality. And this particular piece, for me, it was the best compilation of both frankly the talking points for the optimists as well as the talking points for the pessimists. And if you read and really like in this one article, I found pretty much most of the talking points that I've seen in the media that's published on the housing research side of things. So yeah, let's dig into some of the nitty gritty here, because I think it's super high quality content.
Yeah, I would direct folks to Real Investor Radio /notes. I believe that's correct. Rachel will put that link somewhere in the description, I'm sure. But let's just jump in here. So the article is entitled "Home Builder Bull versus Bear Debate Talking Points." And the bull thesis here is essentially that the long-term underpinnings of housing are healthy. And somewhat surprising, they say that year-to-date 23 demand will rebound and pricing improvement will support this thesis. So bullet point number one, Jack, the new residential has already gone through its recession, they say. Over the past 2 years, new home sales have declined by 22% to 640K. In both 22 and the trailing 12 months ending May of 23. By the way, this report was, it's a little dated. It was done in July of 23. Shelter, Jack, comprises 40% of core CPI. Given the rent home price moderation in the second half of 22, which leads core CPI, the odds of a soft landing or light recession have increased and indicate housing has already bottomed out. Affordability is obviously stretched right now. Builders have met the market with price cuts, including mortgage buydowns, which has been a tactic of theirs to keep demand high. And they're saying, assuming a portion of incentives are used to buy down mortgage rates by 100 bips, builders have already reduced a monthly payment by 10% versus the peak of the second quarter of 22, which helps alleviate the affordability crunch. Builders, their ability to buy down rates is a meaningful competitive advantage versus resale, and new residential offers a better value proposition than resale in a historical context. So what are your thoughts there?
Yeah, like bear in mind that I think there's a perspective. Peter Linneman, who's a housing professor at the University of Pennsylvania, reminds us, I follow his work, and he reminds us on a regular basis that this is all COVID hangover, that we freaked out because we didn't know what COVID was going to do. And we freaked out and we printed a ton of money because we didn't want people to get hurt economically in the midst of a health crisis. And we printed, and in retrospect, we printed too much. But at the time, we didn't know. We didn't know how long this health crisis was going to last. Mm-hmm. So we overshot it, and now we're correcting back. And that's caused some distortions in the financial markets. But this is all just COVID hangover. And in 2019, we had a healthy housing market. And then things became, we printed too much money. If you happen to engage in the market in 2020 and 2021, you got the best of that trade because you borrowed a bunch of really cheap money. And now we're swinging back the other direction, and prices and the price of money has gone too high. But but like a pendulum, it's going to swing too high, and then it's going to come balance back into the middle, and we're going to then, get on with our lives and go back to a productive economy. And there was no reason. This is just the swings back and forth as a result of, the financial engineering that we tried to do to help make things less painful during that period of time. But everything's fine. And if everyone would just, get back to work and let a little bit of time pass, this will just work itself through the system, and we'll go right back into a very healthy economy and a strong housing market. And I get that. That makes a ton of sense to me. Like,
there is a sense that there's a sort of that shock that happens when interest rates, essentially double. Yet the American consumer is amazingly resilient, kind of has a short memory, and we kind of reach an equilibrium point where the consumer ultimately says, "Oh yeah, these rates are here to stay. I've got to get on with my life. I'm going to bite the bullet and go buy a home at whatever the prevailing rate is." One of the next bullet point, which I thought was interesting, Jack, is that the demographics remain supportive. This is part of their bull thesis again. As millennials, which are the largest generation in history, continue to enter their prime home buying years, it's clashing with the current inventory shortage and significant underbuilding that has occurred since the Great Recession. Strong demographics with a structural shortage of homes is a healthy setup. And over the next 5 years, there will be 1.1 more millennials entering their prime home buying years than the prior 5 years. Now, I think there's probably some changing consumer sentiment there as well, Jack. Not all of these millennials are, big on home buying. Many of them, there's a sentiment amongst them. If you take I saw a recent survey of college students. I don't think those are necessarily millennials in all cases. However, 40% of them said, I think I'd rather rent than buy a home. So there is that sort of changing consumer sentiment. But what do you think of that in terms? I had no idea, by the way, that the millennials are the largest, demographic in history. I actually thought that would be the baby boomers, but evidently there's more millennials.
Yeah, all their kids, I guess. The Melody brings up, Melody writes as the bear, and I'll bring up the distinction here. So she would argue the demographics are working. She would argue the opposite of this. I think she would, and she would point out that we've got all these older folk, all the baby boomers moving to Florida, for example, right? Like, to paint with a very broad brush, like moving to the South from the Northeast. And but those people aren't going to live forever, and they're not going to be able to live by themselves forever. And what are we going to do with all these $1 million houses, 4,000 square foot $1 million houses in Florida when these folks pass away? No one's going to want them. And she points to that as a problem from a demographic point of view. So I think this bull thesis points out the broader market, and I think that when we're talking about the median house in the country, this bull thesis speaks more to that piece, which isn't to say that there aren't pockets where the demographics are going to factor in negatively for the housing market. So I feel, lies, damn lies, and statistics. You can twist the math any way you want to in order to make the point that you're trying to make. And in this case, I feel you can either zoom in or zoom out to make to make the argument that you want to make as well. And so when we're talking about bulls versus bears, it's difficult because you have to start with, are we talking about a particular market or the overall market? Are we zoom, where are we zooming? What level of zoom are we using to start the conversation? Otherwise, people just talk past each other, and one person's a bear and the other one thinks the other one's an idiot. Neither of them are idiots, right? They're just using two different levels of zoom when they're starting their conversation.
I love
the demographics one's an interesting illustration of that.
It's it definitely speaks to a macro point, the shifting demographics of the country, and the point that you've made before in consumption. We've all grown very accustomed to our much larger houses, that have been built over the last 20 years. And I think what we're seeing in terms of the younger generation is that many of them don't necessarily look at that, 3,500 square foot house and say, oh, that's something that I aspire to. In fact, a lot of them have said, and a lot of them are renting much smaller spaces. And so, I think to keep an eye on that moving forward, especially in terms of what builders are building, would be a really interesting thing to sort of put a pin in and watch over the next few years.
I mentioned this on the last episode with Melody. I was on the Zelman, Ivy Zelman. Their research is excellent. Yep. They did an online conference, set of panels over the course of 3 days for home builders, or primarily home builders. And everyone was very overt. Ivy was very overt. The home builders were very overt that the size of the new starts is coming down because, as Melody points out, these 4,000 square foot, $800,000, $1 million houses don't have demand right now. But if you put new construction on the market at $399,900, it flies off the shelf. Yeah. And so the home builders are pivoting towards that. It's the reason that build to rent is still a thing, and so yeah, I think that's already started, and I think that's going to continue because of the affordability issues.
All right, next bullet point: supply and demand issue here. So the housing shortage, the U.S. is structurally undersupplied by 1.5 to 2 million units per Wolf's proprietary calculation. Existing inventory is further constrained by rate lock, as existing homeowners are not compelled to surrender their 3.5% mortgages to move to a 6.5+% mortgage. And this continues pushing consumers to new residential as home builders have available inventory and a relief valve for the shortage. With the U.S. adding 1.7 million jobs in the first half of 23, wage inflation is healthy. There has been less turmoil on Main Street that will lead to distressed or missed monthly payments for existing homeowners and an interrelated uptick in existing for sale inventory. Until something changes, tight existing for sale inventory and job growth are supportive of the new residential market gains. So essentially what they're saying is, blue skies for builders.
Yeah, I think I'm sure I'm jumping ahead and the Bears are going to bring up this point, but it's until something changes, I think, is like the operative issue there. And again, now we've zoomed into like everything's fine right now. The consumer is really still very strong. Like this is just the interest rates will steady out. And as long as no one loses their jobs, that being like the big missing piece there. Like if, the X factor in this conversation being, are we going into a recession or not? How severe is that recession going to be? And that your view on that, I think, is, fundamentally connected to your pessimism or optimism for what to do in the housing market.
Yeah. What are your feelings there? I mean, in terms of a pending recession in 24?
So I think I made this comment on a previous episode. Otherwise, it was at the mastermind this past weekend. Mm-hmm. Fred and I, my partner Fred, went down to Miami to the ABS East conference. It's asset-backed securities. It's basically 1,500 white dudes in blue suits. It's super interesting. It's Wall Street conference, and it's all about securitizations, bond buying, and they had a couple economists in the keynote panel, and what surprised me was that these economists had the same view of what was going to happen. Like I'm used to, like you said, you put two economists up on a stage and you're going to have, polar opposite views potentially. But their view was that their view of the next 18 months was that we saw businesses saw cost increases in the wake of COVID, or in COVID and in the wake of COVID, because of the distortions of printing too much money and people not wanting to come back to work. And so businesses experienced cost increases, but then they were able to pass those cost increases through to consumers, and consumers paid. So we've all paid higher prices. That's called inflation. This time, though, fast forward a year, the consumer is much weaker. We're still experiencing cost increases. Some of the supply chain disruptions have worked out, but labor is still strong from a relative point of, from a relative leverage point of view. And so businesses, and not everyone's, dying to go back, dying being back to work. And back to work. So we're still experiencing cost increases, but this time, over the course of the next 6 to 12 months, the consumer is not going to pay it. Businesses are going to try to pass through those continued cost increases. The consumer is not going to be able to pay it this time because their savings accounts are empty and their credit cards are getting to their maxes. And that's going to result in just lower revenues. Those lower revenues and therefore lower profits. So this next phase is that profit margins get squeezed at businesses. And once profit margins start to become squeezed at businesses, they start looking with a little bit more of a raised eyebrow at all of their inputs, like cost of labor, and they start laying people off on a more regular basis. And that is going to be the trend en masse over the course of the next 12 months, is that businesses will just be slowly shedding more labor and weakening the labor market, which will then also result in less consumer spending, which further weakens businesses and causes it to happen even more. And we just slowly cycle down into a shallow recession. In the third quarter of next year was, if you tried to pin them down, that's roughly where they were thinking about this entering a recession. And then we'll be in a shallow recession for a protracted period of time, not a 90-day COVID recession, a year of shallow recession. And then we'll slowly climb back out of it as everyone gets their ass back to work and starts working again and is more productive. And that was kind of a consensus view on the stage, and I thought it was a very interesting take. I'm having a hard time poking holes in it, frankly. I think it's a very plausible path forward. So I don't think it's going to be a super hard. There's no crisis. Their point was and another point they made was there's no crisis. Like we're not going to have a deep recession because nothing horrible. Well, save for war, right? Like war being another X factor.
There had to be one X factor that they threw in there, and I would think that would be a big one.
Yeah. So war notwithstanding, we'll have a soft recession because, and just a shallow, long, kind of depressing, next 12 to 18 months. So that kind of view is like, hey, get used to interest rates for being higher for a little while, but then as the recession happens, the Fed decreases, will decrease rates some, but it won't make a difference because you don't have a job to pay for this stuff. So yeah, mortgage rates came down, but you lost your job, so you're not buying houses anyway. Or you're like, hey, it's the middle of a recession. It's a crappy time to buy a house right now. So once you can afford it, from an interest rate point of view, you won't have a job to qualify for the mortgage. And so that will keep us in a kind of depressed, a shallow, depressed, economy.
I don't like to get into shallow anecdotal evidence, but I speak to a lot of people, and friends of mine who are in sales. They're keeping their jobs right now, but their commissions are getting jacked with. They're just they're essentially being decreased significantly, and I think that's a way for a lot of companies to decrease labor costs without actually doing the round of layoffs that I feel like they're trying to avoid. Especially if they've spent so much money on invested in these better employees. But I've spoken to 3 people over the last 3 weeks, my wife being one of them, whose commission got significantly tweaked. And so I think, and we've heard of layoffs in certain sectors already. So I think we could see some layoffs coming.
Yeah, I mean, housing and mortgages, definitely one of those where there's a lot fewer loan officers today than there were, but still, when you look at origination volumes versus the body count of who's still in the business, there's a ton of extra loan officers still in the market, and if things don't turn around in a year, that's got to continue to shake out. Real estate agents, I mean, transaction volumes are still even lower, which is just crazy that we've been saying that for like 3 years in a row now. But real estate agents are really feeling the pressure right now, and eventually they've got to capitulate and get a day job. So
PNC just went through a pretty massive round of layoffs. They didn't disclose exactly how many, but analysts have said it was sizable. There's been layoffs already in tech. With only about 7 companies really guiding the explosion in tech. So yeah, I think there could be more of that coming.
Anyway, back to the bull. I thought we were talking about the bull side of things.
We are. All right. So next bullet point, and this again, we're speaking really from a home builder standpoint in terms of the overall market. The current mortgage rate today, again, this is written in July, of 6.8%. I think we're around, I took a look today, we're around 7.7 FHA, Jack, right now. So the current mortgage rate sits around 300 to 400 basis points above rates that legacy homeowners are currently holding, which I mentioned previously. This is the highest spread since the 1980s. And so during the 80s, the new home market share increased from 14 to 17% over that 2-year period. And what we've seen over the last year or so, Jack, is that market share for new home builders is still rising above historic levels. They're saying that trend is set to continue based on the, sort of the spread between mortgage rates right now for legacy homeowners and new home buyers. So they're saying, again, throw in that potential right there, and that really speaks to a softer landing, in the market. So I think we've spoken to that, but let's move on to the next bullet point here, Jack. So again, speaking of mortgages, the spread between the 30-year mortgage rates and the 10-year treasury rates is now around 300 bips. And historically, that spread is about 170 bips, which suggests that mortgage rates should compress over the next 12 months once the mortgage market becomes comfortable with the Fed's QT. And assuming that the 30-year mortgage rate versus the 10-year treasury spread normalizes, they're saying that an incremental 5.5 million households would be able to then afford the median price house. Affordability is obviously the big factor here, Jack, with many markets in the country, being the least affordable in history. I read it the other day that Americans are generally spending somewhere between 36 and 40% of their income on housing right now. So speak to that.
I struggle a little bit with this one. Sorry, not to be the perennial bear here, but again, it's based off of the thesis that like, hey, this is going to work itself out, and that the natural spread, the natural credit spread for mortgages is 120 basis points lower than where it's currently priced, 120 basis points lower than where it's currently priced. The difference is that those numbers, that baseline, quote unquote baseline, was the past 15 years when the Fed was an active buyer of mortgage-backed securities. The government was subsidizing our purchasing of houses. And the Fed has now, reversed course and is letting those mortgage-backed securities trail off their balance sheet. They're not buying mortgage-backed securities like they were before. And so it's left to just the private market to set what the appropriate credit spread is. And the private market has said, well, we need an extra 100, 120 basis points. Otherwise, we're not interested. combine that with you have less foreign money purchasing American securities for a lot of
Mhm.
geopolitical reasons. And I'm not sure that I like truly understand the thesis that this spread is going to come back down. Yes, it is elevated, but maybe it's appropriate. Like maybe it's appropriately elevated and maybe it's going to just stay there. And this is just the new credit spread.
Yeah.
And I'm not convinced that there's this natural level that's 100 basis points lower.
Yeah, the funny thing that Wolf states here is that, in their research, they say that clearly higher mortgage rates negatively affect demand. We've seen that. Rates started spiking in January of 21. Historically, rates are disruptive for roughly a year. And after that, home buyers adapt to the prevailing rate environment and move forward with their lives. Said another way, 1 year following rate spikes, housing goes the way of the economy, good or bad. And coupling this with a shortage of homes, demographics, and a strong year-to-date employment growth, this dynamic will keep the market relatively high through 2023 plus, as housing appears less cyclical than past cycles.
I think
I
that's
don't.
the bull thesis. Yeah, that's the
That
bull
is definitely
thesis.
full. Uh, Next point is giving consumers strong balance sheets. It's talking about the health of the consumer and the healthy employment picture. The Fed will be able to engineer the soft landing, which will allow housing demand to stabilize. Now, speaking of the strength of the consumer at this point, read a couple days ago that credit card debt has surpassed $1 trillion. It's much higher than it was during COVID when people were saving more. Um, there's no shortage of people taking out HELOCs, and we're seeing some defaults. So, are the consumers nearly as strong as Wolf might suggest here, Jack?
Well, they used to be, right? They used to be, but today, this was written back in July. I think back in July, people were saying the consumer just continues to exceed expectations, and everything's going to be fine. But I think that we've, for the past 4 months, started to see more and more cracks in the consumer, and
Yeah.
so I'm not a full
Yeah.
bull on this for that reason.
All right. So let's get into the bear thesis, and I think we've already hit on some of these points.
Yeah, skipped ahead.
There, yeah. First point is that housing overall is not healthy. Existing home sales are usually historically 85 to 90% of all home transactions. That is down 25% year over year at 4.3 million houses. This is in line with levels during the 08 to 11 housing bust, the worst housing recession since the Great Depression. And combining this with stretched affordability and a potential economic recession, the housing market is still quite fragile. And although new home sales have stabilized, the industry is benefiting from an unsustainable pent-up second half of 22 demand. So they're essentially saying that all of that COVID demand, has was brought forward, and now we're seeing it's subsided, and that will not continue. The Bulls' argument that the U.S. is structurally short housing inventory conveniently ignores two key items: the affordability issue in the United States and household formation that was pulled forward during COVID. Yeah. Jump in here anywhere.
Keep going.
All right. So the second bullet point here, which I put an asterisk next, is that the undersupplied argument entirely overlooks the affordability side of the equation, which is stretched following a 2.5-year period between 2020 and 2022, where we saw 40 to 45% home price appreciation. If you couple this with the 3 to 400 bip rise in mortgage rates since 21, the U.S. has just experienced the largest affordability shock in history, as the median monthly mortgage payment has increased 100% since the beginning of 2020. This affordability issue will cap home pricing in the next couple of years and continue squeezing home buyers out of the market, particularly if paired with a recession.
Yep. I think that that piece and the prior comments ignore that they assume the consumption stays the same. And I just don't think that's the way that people act. I think that when affordability is stretched, you delay and you have roommates for longer so that you consume less housing per capita in order to make up for that. And so again, I think it's like, what time frame are we zooming in on here? Are we talking about the bull versus bear thesis? Is that, are you talking, some of those are 10-year comments, some of those are 3-year comments, some of those are 12-month comments. And I think a lot of the bear thesis comments are zoomed in on that disruptions that are happening, the COVID, the delay in the COVID pull forward of demand. And so we're in the wake of that right now. And so things are weak right now. Yes, absolutely. And over the course of a 12-month period, if that's what you're really focused on and making a decision as to like what are housing prices going to do over a 12-month period, I think that those are absolutely salient and like the right factors to be taking into consideration. If you're buying housing for the long term, though, they're pointing out 12-month distortions, but those are only 12-month distortions. I think the bull thesis is more convincing if you zoom out to a 10-year investment horizon. I think the bears are a little bit more convincing if you're zoomed in on a 12-month investment horizon. So kind of, so I think that, yes, we're absolutely going to see some distortions in behavior, and we have seen those distortions in behavior. And as a result, we've seen really low transaction volumes. Another thing to consider, I guess, is that when you're talking about a bear, are you talking about, do you care about the nominal? Like, what do we call bear? That the market is slower, that transaction volumes are lower. If you're a real estate agent, that's what they care about. If you're a mortgage broker, that's what they care about is volumes. They don't really care about the absolute level of prices, just that people are transacting. So a bear market to a real estate agent is a low transaction volume market. A bear market to a flipper is a short-term pricing drop, right? Within a 12-month period, prices drop 10, 15%. The flipper cares about that. If you're talking to and so that's a bear market. If you're talking to a landlord, a bear market is one where interest rates are too high or rents go down a little bit, and they're not able to make as much money or any money off of their rental property, or they've got high levels of vacancy because we're in a recession and people aren't making their rent payments, so you're having to go through an eviction. That's a bear market to a landlord. So I think you have to kind of pick your perspective when we are choosing to talk about a bull or a bear market thesis. So all of these points are valid. It's just from different perspectives and from different time frames, and with different time frames in mind.
Yeah, I agree. And I think you've always had a very healthy long-term outlook on the market and American real estate in general. That's always been the Jack Bevere outlook.
Yeah. Though we have, we do a lot of investing on those shorter time frames as well. Something that was really interesting from Real Investor Roundtable. We run this nonprofit mastermind 3 times a year. We get together. We've been getting together in Baltimore, sometimes Dallas as well. But there's a lot of really high level. We run it as a nonprofit. It's meant to just share ideas. There's lots of great masterminds out there that are run on both nonprofit and for-profit basis. We just happen to run ours as a nonprofit. It's really meant to be ideas sharing. And so we try to get very high level operators in the room. And we've, over the past 5 or 6 years, done a good job of that. And
folks from all over the country, right, Jack?
Yeah, folks from all over the country. Generally, everyone in the room's doing at least 50 transactions a year. There's some killers in the room as well who are
Mm-hmm.
doing like, several hundred, like, 400 real estate deals themselves, like not buying a multifamily, not buying, 300 unit buildings, like, no, doing like 300 flips.
Mm-hmm.
And a really interesting, and so they've, they're running bigger shops. They've got to decide how they're going to pivot over time, because if you become one thing and you do one thing, we've talked about this before, then you ride the cycle, you ride the wave of that business model going through, going through the economy. So a better thing to do is be able to do multiple things. And when rentals get tough, flip more houses. When flipping gets tight, wholesale a bunch more. When you're not seeing interesting cap rates and you've got some capital to deploy, start lending instead of, pivot between the equity and debt. And so there's a lot of folks with those kind of balance sheets in the room who are, that's what they're interested in. Like, what is the business model? What geography do I want to be in? What business model do I want to be in? And what part of the capital stack do I want to play in? And if you can pivot, if you were, if you can create a platform that is not, no one's purely agnostic, but that has the ability to pivot between each of those three things, then I think that you can set yourself up a real estate platform that endures and excels through cycles. So, for example, for us in Baltimore, 2 years ago, we were still buying about 100 houses a year. We're still buying about 100 houses a year, but 2 years ago, I was adding 75 of those as rentals, flipping 5, and wholesaling the rest.
Mm-hmm.
Fast forward to today, I'm hardly adding a rental right now because the cost of capital is 8+%. And that's just not accretive. I'm not buying 10 caps. Prices have not come down to the point where we're buying 10 caps and borrowing money at an 8 makes sense. So
Mm-hmm.
we've really pivoted a lot of our pipeline over to flipping. At this past weekend, there are a number of build to rent operators in the room who are building several hundred houses a year. Some of those folks, they were selling turnkey rentals when interest rates were lower,
Sure.
because that was an attractive proposition for a passive real estate investor to be able to borrow money at 4%, invest in turnkey rental real estate. Other folks were doing build to rent and selling to the large funds in packages of 30, 50, 100. And a lot of both of those categories have now shifted towards retail sale,
Mm.
because value has not come down very much. And the prospect of refinancing, whether for a turnkey rental investor, either a single person or an institution, their cost of capital is much higher. So that bid has gotten weaker. The investor bid for turnkey real estate, either as an individual property or a package, has gotten weaker. And so they've shifted, and now they're doing 250 retail sales a year, for $350,000 new construction houses in the Carolinas. And so we've seen those folks pivot to accommodate what we were just talking about, that in the short term, interest rates are high. A refinance exit is not a profitable exit right now. It's hard to get all your cash out and keep moving things forward. And then the money that you have stuck into that refi is not going to have a very interesting return on equity. But there's still an exit to the homeowner, especially in the affordable segments. And so we've seen a lot of pivoting over the course of the past 2 or 3 meetings, big pivots, big pivots over the course of the past 8 months to accommodate this kind of new operating environment and get through that short term.
Yeah, we've spoken to that, Jack, and I think that it takes a really strong operator to make that pivot. I think the average, gal who's out there investing and is doing multiple deals per year, but certainly not that 50 to 100 plus. They feel that they know that they have to make a shift in their business strategy because of rates in the environment. but they don't quite know how to do it. And one of the things I think that is cool about what you guys do with the real estate investor roundtable is that um, you speak to guys who are making those shifts, those massive shifts, and who are figuring it out. One of the things that I think you've spoken to on the past episodes was this. This is a time to really tighten your operations and to maybe get schooled up on some different strategies. Right.
Yeah, absolutely.
So a couple final points here on this really great report. Again, we're on this Wolf Research report. I believe that's wolfresearch.com. The report was entitled Home Builder Bull versus Bear Debate and the Talking Points. Just a couple final points here, that the 30-year mortgage rate versus the 10-year spread is very elevated. We spoke about that. Last point that I thought was interesting, Jack, is there is the supply of multifamily units currently under construction, which is the highest in the past 50 years. And it really dwarfs the past three peak levels of 78, 86, and 2008. It says these multifamily units, generally rentals, will need to be leased up and rented upon completion. There is a concern, however, that the multifamily sector is becoming oversupplied and that potential rent concessions will pressure the for sale market as consumers elect to stay in rental units. Says certainly there's a potential that this will occur, and they believe the decision to purchase is principally driven by lifestyle choices. So speak to that, Jack. We see a lot of multifamily construction around the United States, here in Maryland, a lot of luxury being built that appears to be sort of empty right now. So what are you seeing there?
Yeah, I think that the concern about multifamily is driven by mostly the fact that it's that luxury higher rent per square foot product. It encourages, it's targeted at the millennials, right? We were undersupplied in this 10 years ago. People, we do what we do, right? There's an opportunity to make money building luxury. We build a ton of it and we probably overshoot it because momentum in real estate markets acts that way. And so that's a criticism, and I think a valid criticism because it's competing, right? Shelter is shelter is shelter, and when we're talking about affordability, it is very fungible, a multifamily building unit versus an entry-level home. From a pricing point of view, they're direct competitors with each other. And so depending on millennials' desires to start families, if they delay that, then they're going to stay renters for longer. And so they are direct, and they're building a ton of they have continued to build a ton of nice multifamily. I think multifamily starts are really trending down significantly right now. And so but that's because there's a concern that there's so much in the pipeline that there's going to be an overhang. And if there's an overhang, then it's a threat to rents. And it's not only a threat to multifamily rents, it's a threat to single family rents as well, because those are direct competitors and very fungible with each other. And so, yeah, I think it's a valid concern. And I think it's a valid concern on a micro market basis. People are freaked out about that in Austin and in other markets where there's just a tremendous amount of luxury multifamily building still in the pipeline. And it'll absolutely be a factor. And it's a factor that is going to play itself out over the course of the next 18 months. And so it's tough to weight how much of a factor that's going to be. And depending on the preferences of that millennial potential home buyer, if they can get a great deal in a luxury building, maybe that does tamp down demand for new household formation in single family detached. So yeah, right. It's a threat. I think it's a valid concern.
Yeah, me too. If the price of renting becomes more affordable than owning, which it is in many markets right now, and rents, there is definite downward pressure. I had another report here somewhere in my stack of the downward pressure on rents right now. I think you could see people opting for rent much more than home buying, especially if you can go into brand new building, lovely, it's affordable, more affordable. So yeah. I would love to get some thoughts from folks if you want to comment on this particular report. I just thought it was fascinating. Thanks for sharing it, Jack. It's a great report. I can't wait to see more of their stuff from Wolf Research. Maybe have some of these guys on the show, talk about their thoughts. But yeah, I would love to hear folks' comments on sort of what we talked about in terms of supply and demand, affordability, where the market's heading. We'd love to get your thoughts on it. So go ahead and comment. We'd love to hear you. We'll wrap it up there, Jack. Start up another one in a few minutes here. Guys, thanks for tuning in to episode 22 of Real Investor Radio. And we'll talk to you soon.
Thanks.